Okay, looks like we are rolling here. Thank you so much for joining us today to learn more about steps to financial freedom. My name is Roxanne. I'm a community relations officer here with Neighborhood Credit Union. So excited to be hosting Lauren today from GreenPath Financial Wellness. I'm going to just turn it over to you, Lauren. Maybe if you want to just give us a quick intro about you and GreenPath and our relationship with you, and all those good things, then you can just kick it off into all the great information you're going to teach us.
Thank you so much. Well, welcome everybody to our webinar today, Steps to Financial Freedom, presented by GreenPath and sponsored by Neighborhood Credit Union. GreenPath is a nonprofit financial wellness organization, and we partner with Neighborhood Credit Union to provide financial wellness and education, to members. So we like to do these webinars pretty regularly with Neighborhood. So I want to make sure that I give you a little bit of background on who GreenPath is, so you know about us as a resource. And in addition, keep in mind that Neighborhood Credit Union is a wonderful resource for any questions that you may have. But we are a nationwide organization and we provide financial education and tools. Our mission is to help empower people to lead financially healthy lives. And we do that through counseling and education and debt management services. We have certified counselors that conduct free confidential financial assessments with you. So this involves taking a look at your budget and collaborating to develop an action plan to help you work towards your financial goals. We can also talk about other financial concerns or goals that you have related to things like credit, housing, student loans, and debt. And we've been around for over 60 years, so we have a lot of experience helping people come up with game plans to reach their financial goals. So I will provide you with some contact information at the end of our session today if you'd like to talk to your own financial counselor. Today, we're going to talk about 10 steps to help you reach financial freedom. Now, financial freedom means something different to everyone, and these steps are designed to set you up to work towards whatever financial freedom means for you. Some steps may not apply to your definition of financial freedom, and that is 100% okay. We'll talk about understanding your money personality, setting financial goals, creating a budget, saving, using credit wisely, preparing to purchase a home if that's something you want to do, investing, insurance, record keeping, and of course, the importance of reevaluating your finances on a regular basis. Have you ever wondered why you use money in a particular way? Many forces impact the development of your money personality. You make purchases to fill desires and to make yourself feel a certain way. And some spending influences include advertising, media, society, family, and friends, as well as other things. One way to evaluate your approach to money is to identify your attitudes about money, which is the first step towards financial freedom. Do any of these money personalities sound like you? You might find that your approach to money is a combination of more than one of these personalities. Someone who's a hoarder may like to save, budget, and prioritize, while the spender likes to spend. The planner is the nitty-gritty, take it one step at a time type, and the dreamer hatches passionate schemes, but may not have an idea of how to make those dreams come true. The risk taker loves adventurous investing, and on the contrary, the risk avoider goes for the sure thing. The separatist wants at least some of his or her own money, while the merger wants to pool all of the partners' money together. So go ahead in the audience there, if you have your chat up, share which money personality or which money personalities you maybe identify the most with. For myself personally, I maybe am kind of a dreamer. I like to think kind of big picture, but sometimes I struggle a little bit to activate on some things. So I really need the help of a planner, and my husband's actually pretty good at that, kind of breaking it down one step at a time. I see we've got a spender and a dreamer on there. Oh, Roxanne is too. A dreamer and a risk taker. That's an interesting combination. Um, I know some people, my husband's kind of that hoarder type. He really likes saving, he likes budgeting, he doesn't like to spend money, all of the above. Awesome. So, yeah, we've got a good variety of different people, and there's no right or wrong money personality, but it is important to understand how your tendencies impact the way how you look at your finances. So take some time to discover your money personality by listing the products and services that you enjoy spending money on. Consider which of these spending habits you feel good about. For example, you may be spending money on a gym membership, which helps you stay focused and in good health, and you feel that this is a good way to spend your money. You might eat out regularly, but maybe you're okay with that because it's in your budget and it allows you to spend more time with your friends and your family. At the same time, are there any spending habits that you don't feel as comfortable with and you would like to change? When you understand your money personality and attitudes towards money, this can help you consciously make adjustments and changes as needed to help you achieve your goals. Which brings us to step two. Knowing what you're working toward will help you determine if changes in your spending habits may be necessary to get there. The next step towards financial freedom is setting financial goals. When you are setting your goals, keep in mind the following things. First, being to make that goal very specific. How much do you need to save? How long of a time frame do you have before you need the money? How many pay periods are available to save the money? So, for example, you might need to save $5,000 over the next 2 years for a down payment to buy a house. If you get paid once each month, you need to save about $208 each pay period in order to achieve your financial goal. Next, the goal needs to be measurable so that you can monitor your progress. How will you do this? Just do it in a way that makes sense to you. Determine whether you will save towards your goal each pay period or maybe each month. Check in on your progress towards your goal regularly. Track your progress on a computer or in an app, maybe write it down, or reviewing your savings account balances. Having a goal you can measure progress on is key to being able to achieve that goal. And finally, is your goal reasonable and realistic? You want to set yourself up to reach your goals. Don't try to save so much each pay period that you don't leave yourself sufficient money to cover your other expenses. You may have to lengthen your time frame to achieve a goal and decrease the amount you save each time to ensure your goal is realistic and can be reached. Remember that savings is a lifelong process and a consistent, systematic approach will pay off. Keep in mind that goals can be short term, which typically would be something that you would plan to accomplish in less than 2 years, and sometimes even less than that. An example might be taking a family vacation next summer. So go ahead and pop into the chat if you have a short term goal that you're working on, something in roughly the next 2 year time frame. Share with us what that goal might be. For us personally, we have to redo our deck, which is not my funnest goal, but we need to do it this summer. So it's something that definitely in the short term has to happen. So we moved around some money to make sure that we can pay for that. And we even looked at some financing options too to figure out if that was going to be reasonable. New gutters, Roxanne. That's a not fun goal either, but this is part of this homeownership piece that we're going to talk about. So if you're considering becoming a homeowner, consider that piece. Christy's trying to go on a mission trip this summer. That sounds really exciting. Any other vacation plans? Just save in general. Yes, saving. And that's a big piece of what we're going to talk about for that rainy day or that thing that comes up. So you can also have some midterm goals that will be accomplished within 2 to 5 years, maybe like saving for a down payment on a new car. So think about your longer term goals, maybe within the next 2 to 5 years, what you would like to be able to do. Um, I want some new furniture for my bedroom, and it's not like super critical. We have furniture, but I just would like something new. But again, it's not a priority. So it's something that, we can tuck away a little bit at a time, maybe like 3, 4 years, we'll get something, just but something nice, right? So that's why I want to make sure we have it available. So go ahead and if you have anything in that mid range, pop that in there. And then additionally, you can set long-term goals that you'll probably be saving towards for quite a while, typically 5 years or longer. For many people, this is things like a down payment to buy a house or enough money to retire comfortably. So if you have some long-term goals that you are thinking about, go ahead and pop those in the chat. Retirement's a big one for a lot of people. I have really little kids, but I want to be able to help them out with college. So kind of gradually building up those college funds bit by bit. Yeah, Cherry's thinking about retirement for sure. Absolutely. So yeah, we want to kind of break down our goals into these time frames. So I know that Roxanne provided that workshop guide, and once you get that open, you'll see that there is that workbook. So you can think about this. It's something that you don't have to come up with it right now on the spot, but start to think about your short term, your midterm, and your long term goals and write those down because writing them down really can have an impact on our ability to achieve our goals. Now, in order to know if your goals are realistic and to have a plan to reach them, it's important to know how much money you have to work with. A budget is your plan to achieve your goals. So, step number 3 is creating a budget. So, how many of you have you ever tracked your expenses in detail for at least 3 months? Tell me about your experience. Was it fun? Was it difficult? What did you learn from that? Even if it wasn't a full 3 months, if you gave it at least a good month or two go, I was very into tracking my budget when I was in the process of planning my wedding. I had my personal budget, but I had my wedding budget as well. Um, for me, it was super eye-opening. I don't like to cook. I spend a lot of money eating out or even just kind of grabbing to-go food. So that was something that I had to make a change on. I realized that it wasn't as much of a priority. Roxanne says she spends a lot of money on really silly things. Christy said it was not fun and you spend a lot of small purchases and subscriptions. Yeah, subscriptions really get us. That's why everything has a subscription model nowadays because they know that once you're signed up, a lot of us aren't going to take the time to cancel, right? Fabric, I bet Tatiana is a sewer, maybe quilter. So yep, taking a look at the budget can really help things. In its most basic form, a budget includes the money that you have coming in and everything that you want and need it to go back out towards. It's not until you know where your money really goes that you can make adjustments to your behavior and thus reduce or change expenses in order to free up money to save to achieve your goals. So, if you don't already have a budget, step number 3 is to create one. Having and sticking to a budget is a key step to financial freedom. So start by identifying your income and debt payments, as those numbers tend to be similar on a month to month basis. Then you'll work to get an understanding of your variable expenses, which often seems to be the most challenging piece for most people. Don't forget to include periodic expenses in your budget, such as car insurance or property taxes. Periodic expenses tend to sneak up on people because they're not budgeted for ahead of time. This can result in progress towards financial goals being derailed and potentially escalating debt. Now, people often find opportunities to save money by making small habit changes in a variety of expense categories. Identifying ways to change spending habits that will free up money to reach your goals can be very exciting. So, while these are recommended ranges as you set goals for your own budget, please know that everyone's budget can and will and should look different based on your financial situation and goals. So, I really want to reiterate this. Your budget should reflect your financial situation, your financial goals, and your financial priorities. If being able to go out to eat regularly is something that's a priority for you, that's okay, as long as your eating out budget is larger. And you can do this as long as you've accounted for it in your budget and you're comfortable that your other needs are being met and your goals are being worked towards. Creating a budget with your goals and situations and priorities in mind so that you are sure it's realistic for you to stick with is the biggest tip for creating a budget that works. So this is when I think about like a lot of times maybe young people, right, are still living with their families. So maybe they don't have a housing expense or they have a very low housing expense. So they might have some more room in their budget. For example, maybe they need to spend more money on their car insurance because they're younger, right? So you can have that flex in your budget depending on what your priorities and your needs are. Now, it's easy to think that if you only got a raise, you could reach your financial goals. But having more money coming in without a plan of where you want it to go can easily lead to that goal feeling even further away than it did before. This is a phenomenon that we call lifestyle creep. So, whether you have $10,000 a year coming in or $1 million a year, having a plan for where those dollars go is key to reaching your goals and experiencing financial freedom. We've all heard about people that are kind of overnight successes, maybe music artists or athletes that make so much money, but then they clearly don't have a financial plan and they end up going bankrupt, right? So It really isn't what you have coming in, it's how you're handling that money. So, next, let's talk about the importance of savings. Our fourth step to financial freedom is making a plan to save money. Many of us pay our bills first and then spend on a regular basis. And then at the end of the pay period, there's no money left over to save. Including savings in your budget and treating it like any other bill can help you get into a disciplined method of paying your future self first. Setting up an automatic savings transfer on payday can help with this. If it goes to your savings account automatically, many people don't actually miss that money. But if they have to make the transfer themselves, they may be good at talking themselves out of it. Commit to starting treating savings like a budget expense now, even if it's a small amount like $10 a paycheck. Reevaluate your budget regularly to look for opportunities to increase the amount you're saving over time. Did you get a raise? Pay off debt? Then go ahead and increase your savings transfer. An emergency savings account is money that you have tucked away for an unexpected, unavoidable expense. This may be things like an unexpected car repair, a medical or vet bill, a home appliance replacement, or unexpected travel for a family emergency. Having money in a separate savings account for those unexpected expenses helps you to avoid having to turn to credit cards when these expenses arise. Keeping your emergency account separate from other savings ensures that you have money dedicated to these unexpected expenses while also working towards other savings goals separately. Clearly define with those that you share finances with what an emergency truly is and commit to only touching those funds in those situations. Now, we mentioned periodic expenses before when talking about budgets. So these may be things like regular car maintenance, holidays, birthdays, anniversaries, insurance, vacations, and other expenses you know you will have from time to time, but not necessarily every month. So, sinking funds are designed to help you be financially prepared for these unexpected expenses so you don't find yourself caught off guard when they arrive. So, to determine how much you need for sinking funds, estimate how much money you will spend in the following year in each category and divide those numbers by 12 to determine a monthly amount to save for each anticipated periodic expense. This helps you treat periodic expenses as monthly expenses in your budget. You can even take it one step further and divide each expense by the number of pay periods per year. If you get paid every other week, that's 26 pay periods per year. If you anticipate spending $1,000 during the holiday season, divide this by 26 pay periods, and you'll see that saving $38.58 per paycheck in your holiday spending fund will ensure that you have the $1,000 already available when the holiday season rolls around each year. Consider either setting up a separate savings account for each sinking fund to ensure that you're using this money for the intended purposes. So when you get to that workshop guide, there are spaces to start listing your own sinking funds. So maybe think about and even put in the chat if you can what periodic expenses that you might want to create some sinking funds for. The holiday one is a great example. The other one I think about is clothing, especially like if you have kids, like they're going to grow, they're going to need clothes, they're going to need shoes. So I like to think about that almost like on a quarterly basis or biannual basis. A lot of people will do like kind of a fall, winter shop, spring, summer shop. So think about how much you might spend there and divide it out by the frequency that you go shopping. Make sure you put that in your budget because you know you're going to need that. Awesome. So yeah, think about some of those sinking funds you'll need. Now, we've talked about budgeting and savings, but occasionally there may be a purchase you need to make that is larger than the cash you have on hand to cover. And this is when accessing credit can come into play. So, step 5 is using credit wisely when these situations arise. Credit is a tool that can be used to purchase expensive items without having to save for years and years to pay for them outright. It can also be used to manage your budget and track your spending. However, if not used responsibly, credit may get out of control and create many hurdles that you will need to overcome. Remember that credit is not extra money that you can access without having a solid plan to repay the amount that you borrow. As we discussed earlier, it's important to know your money personality. If you're a spender or risk taker, you may want to avoid carrying credit cards around to avoid impulse purchases. Create some clear guidelines on when you'll use credit and develop an accountability system to help you stick with those guidelines. Like we discussed in step 4, make sure you have savings built into your budget for emergencies and for those periodic expenses. Having funds saved for these situations will make it easier for you to use your credit wisely. Avoid using credit cards to charge unnecessary items if possible. And if you need to charge for an unexpected expense, prioritize paying it off as soon as possible. To maintain a good credit score, keeping your credit card balances under 30% of the credit limit is recommended. If you max out your credit cards, your credit score will likely drop. Additionally, late payments can have a quick and significant negative impact to your credit score. If you are concerned that you won't be able to pay a bill on time, you should reach out to the creditor or a nonprofit credit counseling agency like GreenPath to explore your options. The sooner you call, the better. Creditors can't help you if they don't know what's going on in your situation. And finally, be sure to check your credit report regularly for accuracy. You are entitled to obtain a free copy from each of the 3 credit bureaus every 12 months. And I encourage you to do that on annualcreditreport.com. I'm going to put that in the chat. This is the free government sponsored site for you to get all 3 credit reports. And with the pandemic, they've been allowing people to access those on a more regular basis. So you might even be able to check that a little bit more frequently than annually. So buying a home is typically the largest purchase that most people will ever make. And if buying a home is part of your financial goals, making sure that you're prepared before this massive purchase is step number 6. Now, mortgage lenders don't look at all of your expenses when they're pre-approving you for a certain mortgage amount. So before talking to a mortgage lender, evaluate your own budget closely and determine what you feel comfortable spending. Do you anticipate any changes to your income or expenses in the next few years? Let the potential lender know both the overall purchase price and the monthly payment ranges you're comfortable with and work towards those numbers. You may hear a lot about down payments, but buying a home can involve a variety of additional upfront costs that are important to be aware of and be prepared for. There are many great programs specifically for first-time homebuyers that can help alleviate some of those upfront costs. So be sure to research homebuyer programs in your area, especially if you are buying your home for the first time or if you haven't owned a home at least in the last 3 years. Not only will you typically have costs associated with the actual purchase of the home, but you'll want to be sure that you have emergency savings for anything that goes wrong once you're a homeowner, now that you're responsible for covering in the household. Many people also typically want to purchase new furniture or decor to make their new home their own. So having money tucked away can help to avoid going further into debt as a new homeowner. Most lenders will prefer that you spend no more than 28% of your gross monthly income, which is your pay before deductions, on the principal, interest, taxes, and insurance for your new mortgage payment. Add this anticipated payment to your other monthly debts, and they typically don't want that amount exceeding 30%, 36% of your gross income. These calculations are known as your debt to income ratio. In addition to your credit score, the debt to income ratio is weighed heavily in a mortgage lender's decision. So think about what are some debts that may fall under this debt to income ratio? What other debt payments might people have that a mortgage lender would take into consideration? Car loans, yes, very good, Christy. Definitely, if you have a car payment, that factors in. Student loans, absolutely. And even if you're not paying student loans, that's something that mortgage lenders typically have a calculation to figure out. So that's important to know as well while our student loans are temporarily on hold. Debt like credit cards. Yep. So credit cards, any personal loan or installment loan payments. If you have another mortgage, maybe you're a co-signer on another loan, but that person pays it. Yep, anything really that could potentially show up on your credit report is typically what's considered. Now, to reiterate, this ratio doesn't consider other expenses that you might have outside of debt payments. So you may have additional large expenses like childcare, which is why it's imperative for you to know what payment your overall budget can support, regardless of how much a mortgage lender says you can afford to pay, because they're typically not looking at that entire budget. They're looking at that gross income, but they're not looking at the particular expenses you have outside of those debt payments. Now, it is easy for us to think that retirement is forever away and that you have plenty of time before you need to start thinking about and planning for it. However, the sooner you start investing for your future, the better, which brings us to step number 7. Once you have a place to live, a budget that works for you, money tucked away for emergencies, and your monthly debt payments are at a comfortable level, building a nest egg for your future can begin or continue at an increased pace. Now, please know that this is general for information purposes only. Unfortunately, I'm not licensed to give any legal or investment advice. So I would recommend you consult with an investment professional if you would like to get more information on investments that are best for you. When it comes to investments, the higher risk options usually means higher returns, but it can also mean bigger losses. And this is another example of how knowing your money personality can help you to make decisions. Are you a risk taker or more risk adverse? And this can directly impact the investment decisions you make. To outline a few options in general, investing in stocks means that you own a piece of the company that you buy a stock in. It's important to seek professional advice as stock investing has many pros and cons. Bonds are issued by governments or corporations when they want to raise money. You buy a bond, which will have an end date when the principal of the loan is due, and there will be terms for the interest payments made by the borrower to you, the lender. Mutual funds let you pool your money with other investors to buy stocks, bonds, and other investments. 401ks and 403bs are retirement savings plans that are offered by employers for their employees. For government employees, the 401k equivalent is the Thrift Savings Plan or the TSP. And the money saved in these plans is before tax, and the investments grow tax-free. Withdrawals in retirement are then as taxed as income at that time. As a part of their benefit plans, some employers often offer to match to encourage employees to contribute to these savings plans. Since this employer match is essentially free money for your future, you should prioritize making room in your budget to contribute enough to receive the full match every year to receive this benefit. Consider automatically increasing the amount you contribute to your retirement plan when you get a raise. Some employers will even automate these increases for their employees on an annual basis. Now, know that there are limits on how much the government allows us to contribute to our retirement plans, and these can change each year, so it's important to stay up to date on these annual limits. Two other retirement savings accounts are the traditional IRA, which is an individual retirement account, and the Roth IRA. As implied by the name individual retirement account, these plans are great options for people that don't have access to an employer's retirement savings plan, such as a 401k. The traditional IRA is similar to the 401k in that contributions are tax-free, investments grow tax-free, and withdrawals are taxed as regular income. The Roth IRA contributions are made after taxes are deducted, at which point investments grow tax-free, and the withdrawals are also tax-free. Roth IRAs can also be used by people without access to an employer plan. What do you own of measurable value that you can't easily or affordably replace or repair without insurance? Step 8 is to make sure that those valuable assets are insured. Auto insurance protects you against financial loss in the event of a car accident or theft. There are many things to consider when obtaining an insurance policy. Many states have specific coverage requirements, which you'll want to know for your state of residence and research if you do plan to move to a different state. You will also need to determine how much coverage you need and how much the premiums will be. Compare with multiple insurance carriers to determine what you need and the cost of coverage with each provider. Renter's insurance is intended to cover damage to or theft of your personal property, liability, and loss of use, but not damage to the building itself. It's important to know a landlord's property insurance typically wouldn't cover your personal belongings. Renter's insurance is usually very affordable and can provide you with a lot of peace of mind as a renter. Most lenders will require homeowners insurance on any property that is used as collateral for a loan. The amount of insurance you need depends on the value of your home and your possessions. It's a good idea to take an inventory and discuss it with a professional before determining a coverage dollar amount. Even if you own the home outright without a lien, maintaining a home insurance policy is still a good idea. You've spent years investing in your home and building equity, and this is a way to protect your your investment. Now, it may be odd to consider your health an asset, but it definitely is. Determine your health, dental, and vision needs and what coverage makes the most sense for you. Does your employer offer insurance plans that meet these needs? You can also explore options at healthcare.gov if you don't have employer coverage. Of course, your life is your biggest and most invaluable asset. Life insurance provides financial security and helps ensure that there are funds to pay off debts, pay living expenses, and pay any medical and final expenses. Review your assets and obligations to determine the amount of life insurance coverage that would meet these needs. Talk with an insurance professional to determine options and costs. Now, there are two primary types of life insurance called term and permanent or whole life insurance. Term life insurance provides coverage for a specific amount of time. If you outlive your term, you would be responsible for securing a new policy to continue being covered. Permanent or whole life coverage provides you with an insurance policy that you can continue for your entire life, and it does typically cost more than term insurance. Long-term disability insurance is intended to cover lost wages due to a disability and can last a specific term or until you're eligible to draw Social Security. Long-term care insurance will cover a daily amount for services to assist with the activities of daily living. The cost of long-term care can vary greatly depending on your age, reimbursement amount, and other optional benefits. So we have talked about a lot of things today, and that will involve paperwork and records. So keeping your records organized and easy to navigate is essential to managing your money. So step number 9 is keeping good records. So first, you want to gather all of your important documents. This includes banking information, investment information, your tax filings, copies of your insurance policies, debt obligations, titles and legal documents, including wills and trusts, passports, birth certificates, marriage licenses, and social security cards. Next, determine where and how you want to store them. If you are storing them in a filing cabinet or safe, make sure that it's organized and secure. Store similar documents close to each other so they're easier to find. Also, consider a fire-safe record storage solution. As you get new accounts and policies over time, be sure to update your records regularly. If you prefer to store your documents digitally, make sure you choose an encrypted and backed up storage option so you don't lose access to your important paperwork. And finally, step to financial freedom number 10, reevaluate all of these things regularly. None of these steps we discussed today are a one and done thing. All of these steps to financial freedom are ongoing and require reevaluation as your financial situation and goals may change over time. On at least a quarterly basis, revisit your budget to make sure it's meeting your needs and it's an accurate reflection of your current financial situation. Make any changes that are needed as appropriate. I also would encourage you to quarterly evaluate how much you're contributing to your savings and to determine if you can increase that amount. This is especially important when you're just beginning to build those savings muscles into your budget and you're starting with a small amount as you get into the rhythm of budgeting. On an annual basis, review your credit report from annualcreditreport.com. Is everything accurate and were you aware of everything reporting? How do you feel about your debt load? Are there any changes you would like to make to your credit usage? Also, revisit your financial goals at least once a year. Which goals have you reached? Which goals have maybe changed? How are you progressing towards your active financial goals? Are there any changes to make in your budget or spending habits to ensure that you're on track to reach your goals or to account for any new goals that you may have? Take a look at your investments each year, as this is another great habit to get into. Are you in a spot where you can increase the amount that you're investing? How is your current portfolio performing? How do you feel about that performance? Is it time to consider any changes to your investment portfolio? It's also a good idea to shop around for insurance policies that might better meet your needs or save you some money on an annual basis. And finally, whether you store your records physically or digitally, go through your records at least once a year to make sure they remain organized and up to date. Consider which records you may be able to securely dispose of. So hopefully these steps help give you some ideas and steps to take. And Roxanne has a copy of our slide deck for today, and I will be making sure I get her the updated copy as I added a little bit of information. She will be sending that out. If you feel like you need any help with some of these steps or need some additional support or guidance, please feel free to reach out to us here at GreenPath. You can give us a call at the number on your screen, 877-337-3399. You can also visit the link that Roxanne put into the chat, greenpath.com/neighborhoodcu. There is a lot of digital education and tools available to you, as well as more information about our services. And I want to remind you as well to use Neighborhood Credit Union as support. They may be able to help you with some of these savings goals, help set you up with additional shares if you need to do that for your sinking funds, get you some investment advice, or get you in contact with an investment professional. So a lot of the steps that you need to take today can be supported by Neighborhood Credit Union. And if you do want more financial education, we have our Learning Lab Plus that's available through that greenpath.com/neighborhood credit union link. You just click on Learning Lab Plus at the top. There's over 16 different financial courses on there that you can go through at your own pace. They're all interactive. So if you like the information we covered today and you want more, be sure to check that out.
Awesome. I did post some of those links in the chat, so take a look at those. I'm going to go ahead real quick and stop the recording and see here.